Now, when we look at SPV administrators, all right, and I'm going to include syndication platforms in this bucket, some key considerations. If you think about the breakdown of what it takes to do this on the back end and why I say, don't do it yourself. It's a massive pain. It's not worth your time and money, right? When I meet syndicates or groups and they're saying, hey, you know what, we find SPV costs too expensive. What I find actually is that they're solving for the wrong problem. The problem is that their raises are too small. Usually it's sub $100,000. And so then the SPV cost is too high as a percentage of the total raise. So the core problem you need to solve is build your investor network, find better deal flow, do better due diligence, learn how to engage your investors better, and get above that $100,000 number, right? Because otherwise you're trying to just trim fat, right? And it's just, you can't trim your way into a structure that works economically. When you're working with administrators, this is a little bit of a US-centric view, but the structure applies across multiple jurisdictions. The terminology might change. Usually there's a concept of a master entity. In the US, it's an LLC, under which there are subordinate series structures. The reason for this structure is that with the administrator, they only need to do one master entity, and they do tax filings for that one master every single year for all the underlying series entities, which basically means economies of scale. It drives down the cost of operating this. There is governance involved. At the entity level, you need subscription agreements, operating agreements, private placement memorandums. You also need to do governance at the investor level, which includes things like accreditation, KYC, AML. There's an administration function, which includes bank account setup and shutting it down, document e-signing, wire transfers, and handling side letters like pro rata, carry sharing, waivers, all of these things. On an ongoing basis, there's maintenance on the entity. You need to keep these legal structures alive during the entire life cycle, and there are fees involved. There's also going to be accounting on each of these entities on the year of the closing and generating tax documents for investors. And at end of life, there's two scenarios. It's either a liquidity event or dissolution. In both cases, there's going to be tax filing and closure of entities. If there's liquidity to be returned, we have to do returns calculation, bank account setup, returns distribution. We've just spent 3 minutes talking about this slide. I don't know about you, I'm exhausted already, so I don't want to deal with this myself. The disciplines that we need to solve all of these boxes are registered agents for the entity creation and maintenance. You need a legal function for governance, a corpsec for investor accreditation. The administration is largely a corporate secretary function. You need registered agents to maintain the entities, a tax accountant for accounting, and then the same thing at end of life. So a lot of disciplines involved in this. So yeah, basically takeaways, don't do it yourself. It's just not worth it. The question is, what are your options then if you're not doing it yourself? And the simple answer is you either use a syndication platform or an administrator. When you're selecting an administrator, you don't want the cheapest guy in the room. Okay, you want the person who's going to be around in business through the life cycle. So cost is not the number one thing that I look at. It's survivability. For what I do, I stay in touch and get to know administrators and the syndicate platforms around the world, and we forge good relations because we want to have those relationships so that we're comfortable vouching for them. And so some of the platforms and administrators that we're working with, I'll showcase here. If I've got sufficient degree of confidence, I'm going to flash through pretty quickly. The detail is going to be available in the slides. If any of you want introductions or to speak with them, please reach out. I'm very happy to make introductions for you. In the US, we're tracking a few platforms. One is Sidecar. Another that is in the market is Vauban. They were acquired by Carta in the last couple of years. And a third option you can consider is AngelList. In Europe, we have Odin in the UK. Vauban is also a player, UK-centric. And in EU proper, you can maybe take a look at Roundtable. They use Luxembourg vehicles, but they serve the Europe region, the EU region, I should say. And within AsiaPac, we've got Optimate based out of Singapore, and then there's also Aussie Angels obviously in the ANZ region. Now, I'll end off with this, right? We'll just talk about some syndication use cases. Firstly, the core value prop of syndicates is deal-by-deal venture investing. Investors get decision control over portfolio construction and capital allocation versus a fund structure, which is a big-ticket, passive, blind pool investment. SPV structures ideal for venture assets because we have a long lifecycle legal entity that is cost efficient to maintain for 10 years. It also fits that liquidity timeframe of venture investments. Outside of the investment and liquidity events for venture, they're largely dormant. So there's very little tax reporting or maintenance needed during the life cycle. This is why the SPV structure makes sense. Syndication into funds. This is a topic that has come up. It is technically possible, but there's a few practical barriers. One is the value proposition, just very basic. Fund value propositions is a completely different product from deal-by-deal syndicates. Okay, so with a fund, investors, LPs, are buying diversification, passive vehicles, large AUM vehicles. By diversified returns, we're talking about a top quartile fund generating around 3x. So this generally doesn't fit the returns profile that venture investors are seeking for. And if you are a syndicate within a fund, you have a carry stacking problem because both the fund and the SPV will take fees plus carry. So in the scenario that you're an SPV with 20% carry under a fund, that returns, this should be 3x, you're netting off 2.4x returning to SPV investors. And so we get into this range of a bit, what's the point? Some potential innovations from discussions I've had, I think deal-by-deal syndication could be applied to income generating assets. It is a compelling value proposition. So use cases here could be search funds or maybe even credit products. On the other hand, we would need to solve regulation and liquidity mechanisms. So how do you return periodic dividends to investors, right? Classical SPVs tend not to be good for that.